You must have observed the correction that occurred in the broader market. The S&P 500 is correcting from the heights of 4,600, which is its highest level this year, 2023. And it has, it's correcting from those levels, from those heights down to where it is right now, which is around 4,365. And we're also seeing other things in the broader market, in the bond market. Some investors are trying to get back into the bond market to lock in the current rising yields. And this rising yields also comes at a time when the price of these bonds are also dropping. So there's this correlation between, there's an inverse correlation between yields and prices. When the yields are rising, the prices are going down. So it can look attractive. The prices are dropping, the yields are rising. You want to get in. But at the same time, it can also be very risky. That is why the likes of First Republic and all those banks that have failed, because these companies, these banks are locked in a lot of money in bonds, in treasuries, and they have dropped in value. They have collapsed because the yields are rising. I mean, you have seen what has happened to them. So that is what we're seeing amongst other things. You must have been observing all of these things. So the rise in yields, obviously, like I mentioned, move inversely to prices. It comes at the heels of a slew of data that suggests the U.S. economy may be stronger than previously thought, and in turn, inflation may now take a longer to moderate. That has prompted investors to push out their expectations for when central banks will be able to start cutting rates. The U.S. Federal Reserve went as far as to warn that there was a significant upside to inflation in its minutes published on Wednesday, the 16th of August, even though some officials appear more skeptical about the need for further rate rises. We've also seen that some data from the U.S. Treasury Department shows that the value of treasuries owned by Japan and China, the two biggest owners of U.S. debt, fell by 11% and 12%. All of these are also pressuring the Fed to keep on raising rates, or to keep sustain rates at this sort of levels, because by doing so, they will attract more sales. By doing so, there's the yield is there, yield is looking more attractive, and also the price is also dropping. So you can get in and also lock in those yields. So that is what is pressuring the Fed, amongst other things. That's not the only reason, but these are one of the main reasons. And then as it concerns the equities or stocks, with the rising yields, which is interest rates, then it becomes difficult to borrow money and keep financing some of these deals. Because this equity market is where this is where the money is raised, amongst other things. So the companies come to the stock market, they bring the debt they have raised to the stock market. The funds that are going to lend them money are going to sell. They're going to redeem their what they lent to them in the stock market. So they're also finding it difficult to raise these funds to lend to finance companies. They're finding it's becoming a lot more difficult because they also have to borrow, and it is at this rates that the Fed is pushing up this same attractive yields to bond investors. This is also the same rate that is that is affecting the funds that are going to fund companies. So all of these are impacting the equity market directly or indirectly. At various points, the investors in the markets overlook all of these things. They may overlook rising rates and keep driving the price higher. We saw that. It's not today that the rates have started to rise, and the value, the S&P 500 printed those heights even in the midst of rising rates. So this is also, it's a mix of things. It's a mix of things. The markets, the equity markets don't remain there. They don't remain stagnant. They don't stay there and keep crying about the rising rates. they still move forward. So a lot of things are going on. We're seeing a correction. We have, like I pointed out earlier on, a correction has happened, but at the same time, looking forward as well, there's still potential for for the broader market to surpass the levels it reached as of late July, which was around 4,600. It's likely at some point, maybe not this year, or maybe this year, to even break that resistance, even continue to extend further. So the labor markets, amongst other things, also remain tight as well, with average hourly earnings in the US increasing by 4.4% year over year last month of July. And it makes of a lot of things going on in elsewhere in the world as well. Those are those are amongst other things. These are the things that are going on. US retail sales data this week, that's the week that ended on the 18th of August, was significantly more buoyant than expected, rising 0.7% in July, while the Philadelphia Fed's manufacturing business outlook survey for August surged to its highest level since April of 2022, with growth so set to print around 2% for the third quarter in a row. It is not clear why inflation pressures should dissipate, according to economists at Citigroup. So a lot of things are going on. Let me show you the chart of I've just closed that, if you don't mind, the chart of trading view. Let's see, chart of US Treasury US 10-year note. Let me show you that chart of US 10-year notes. Let's see. 10 US note. Yes, this what you see is that the chart of US 10-year treasuries. You can see that it has been dropping since it's been the price. This is the price of 10-year US treasuries. They've been collapsing since. You can see we had a double top. The first one was on the 3rd of May. The second one was on the 11th of May, and then the second one was lower than the first one. And you can see at this point that we had a confirmation of a bearish trend. You can see that it fell below some of its moving averages and has continued to retrace. These are all the sort of things. This was around the time we're having the issues with some of those banks. You can see that we started around at this point. I know First Republic was already in trouble as of early May. It was already in trouble, so you can see the bearish trend was confirmed. As of the 16th of May. So this is the 10-year treasury. This is a chart. This is the prices been dropping, and then the yields have also been rising. So see what you make of all of these things that are going on in the US economy. The strength of the US economy is prompting investors to rethink on the rates trajectory. So I'll definitely continue to update you. Thank you very much for watching this video.